Thank you for tuning in to Startup Builder Videos on YouTube. I'm Mark Weinberg. Startup Builder Videos on YouTube is an online video blog about startups and small businesses. And today I want to take the time to talk to you about financing a startup business. They say basically you need money to make money. And in case of starting up a business, that is definitely true. So the number one way of actually financing your startup business is using a savings account. Most of the time entrepreneurs, work at other jobs. They save up some money from their paychecks and they put it into their savings account or even their stock brokerage accounts like E-Trade or Scottrade. And sometimes they liquidate some of the money from that and they put it into their business. Another form of financing here that's widely used is the home equity loan or home equity line of credit. Basically, you are taking out a second mortgage on your home based upon the equity value that your house has. Now, the thing here is that due to the way the housing market is today, a lot of home values have decreased and entrepreneurs have not been able to take out as much money as they would like to have. Another problem here with home equity loans or lines of credit is that if your business happens to fail, your home could basically end up in foreclosure and basically you could lose your house. Another widely form used of financing here is credit cards. A lot of entrepreneurs have funded using their personal credit cards. If you happen to be lucky to get a business credit card, that's also good too. Sometimes they do ask for a personal guarantee, definitely on the personal credit card, sometimes on the business as well. The thing about credit cards, they're easy to use. You get a lot of them, and a lot of entrepreneurs have used credit cards over the years. The problem here is if you default any of these credit cards, you could be facing high interest rates and penalties, and high interest rates as high as 30% or so. Another new form of financing here is called crowdfunding. Crowdfunding basically is a new development, and it's having it's using the online community to raise capital. This could be peer-to-peer lending sites such as Prosper and Lending Club, where you're able to borrow money from the online community up to either $25,000 or $35,000. And I think the paybacks could be maybe about 5 years or so. And based upon your credit there will determine how much the interest rate is going to be. There's also certain other types of crowdfunding sites that are more like donations, such as Indiegogo.com, where you don't have to pay it back, but have to provide some type of benefit. For example, if you're showing a film or we're working on some type of film project, then you allow the customer or the person who financed it, they have the option of seeing that film early, or getting other types of fan type of products, stuff like that. So crowdfunding is a very new option here, and you should check it out. Another source of financing here obviously is bank loans. Depending upon the bank, you'll probably have to provide some collateral for the business. Bank loans basically are best for Me Too businesses, laundromats, restaurants, car washes, nothing that's so high-tech or niche out there that bank loan officer is going to be like, I don't understand this. So basically, Me Too businesses are the best for bank loans there. And like I said, you're probably going to have to provide some form of collateral for those loans. Most people don't even bother with the bank loans. They'll go get a home equity loan, which might be easier to do from their house and easier to close. All right. The next type of loan here is SBA loans, or Small Business Administration loans. Now, some people think that the SBA itself is the ones that give out the loans. That is not true. They're given out by certain banks that are qualified and trained to give out SBA loans. The most common loan is the 7A SBA loan there. And the good part about the SBA loan, it's going to require some collateral, but maybe not as much. The good thing here is you're probably going to be paying a fixed interest rate and a longer payback schedule. And that's the good part there of the SBA loans. I think there are other loans such as the Express Loan Program. It's a little bit lesser amount that you can receive. And there's also for veterans, the Patriot Loan Program as well. You could go to the SBA website there and inquire more about the SBA loans. All right, now we're up to getting another financing when financing your startup business. Another form here is venture capital. Venture capital, and I would also say angel capital. But first, let me focus on the venture capital here. Venture capital represents about 3% of businesses that get financed. It's an equity form of financing, meaning that the venture capital form takes stock in your company, could be preferred or common, and they give you capital in return there, where you don't have to pay it back. It's mostly for high-tech businesses and medical type of businesses as well. It has to be basically a lot of that the business is able to scale or grow very big, very quickly. And venture capital looks for an exit strategy, normally within 5 to 7 years. Normally between maybe an IPO, initial public offering, to get on the stock markets, or you sell your company to a bigger type of high-tech corporation like Google and Microsoft. There's also the other option now available is the private stock exchanges that are on, that's called Second Market and Shares Post. And they also are a new way for venture capitalists to be cashed out. Last but not least here is angel capital. It's very similar to venture capital. The difference here is that angel capital is an entrepreneur who had most of the time been very successful in their business and now want to help out other entrepreneurs. So they provide capital and sometimes advice to new coming entrepreneurs there. Angel capital could be just from an individual or sometimes groups. There are angel capital groups out there that function very similar to venture capital. They too have very similar exits, an IPO or they sell the company or even a private stock exchange. Angel capital, it's sometimes tough to find angel capital. You just have to really keep searching different entrepreneurs out there who have been very successful and willing to help you out there. There's also something called super angel funds. They invest small amounts of money to a lot of startups there, so you might want to check those out as well. But these right here are the 8 different types of financing for your startup business. Okay, so go ahead and check it out. I'm Mark Weinberg with Startup Builder Videos. Catch you next time.